The biggest mistake, the most important mistake, I think 90% of people in crypto are making is that they don't realize that ETFs are multi-year stories. So
Mhm.
usually in an ETF, it really struggles to get any assets in its first 6 months or its first year or its first 2 years. And it hits its stride in years 3, 4, 5, 6, 7, and 8. If you look at the gold ETF when it launched,
Yeah.
everyone was excited. The best performing ETF of all time. Year one was the smallest year I think maybe it ever had until it had a negative year. It had 8 years of ascending flows. The reason I bring that up is I have a high degree of confidence that flows in 2025 will be bigger than flows in 2024. And then I have a high degree of confidence that flows in 2026 will be bigger than 2025.
Hey everyone, this episode is sponsored by Polkadot. Polkadot is the largest community DAO empowering 1.3 million dot holders to shape the future of the network through active participation. With over 500 applications backed by over $6 billion in shared security, Polkadot's adaptable technology powers a diverse ecosystem from DeFi to AI. Join the Polkadot DAO and be part of that transformation. This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gendrop campaign and be part of the future of regulated digital assets today. Welcome back to another episode of On the Margin, and joining me today is Matt Hougan, Chief Investment Officer of Bitwise Asset Management, one of the top Bitcoin and ETH ETF firms in this space. It's great to have you here, Matt. What's going on?
I'm so excited to be here. Thanks for having me.
Yeah, totally. I was just looking at a recent panel that you did at DAS London where you were joined and talking about some of the perspectives on the more recently launched ETH and Bitcoin ETFs, and just wanted to get you on the show and just get some updated thoughts here. So right off the bat, just want to dig in with the top down here. Just ask you, we're about 10 months or so into the ETFs being launched, and has it gone as well as you expected, worse than you expected, and what's your overall perspective on the launches?
Yeah, I would say better than I expected. I was really bullish on a Bitcoin ETF and an Ethereum ETF. We worked on it for 5 years at the SEC. I beat my head against the wall, made my hair turn gray. So I was all in, but it exceeded my expectations. I don't think anyone looking, particularly at the Bitcoin ETF, we can even talk about the Ethereum ETF, but anyone looking at the Bitcoin ETF has to admit it's the most successful ETF launch of all time. I've been really pleased to see multiple players win. That's actually good for the space. It's good that BlackRock is out there talking about it, and Bitwise is talking about it, and Fidelity is talking about it. That's been really nice. And I think we're just getting started. I think next year is going to be a bigger year than this year. So, from a 30,000-foot perspective, it exceeded my expectations on Bitcoin. I think Ethereum is a mixed story, but there are reasons to be bullish there. But I'm really, really pleased.
Awesome. Yeah, let's focus the conversation first on Bitcoin, then we can get into ETH afterwards. So, when you say that it's the most successful ETF launch of all time, how do you measure that? Is it flows or volume, or how do you measure that?
Yeah, absolutely flows, right? So before I joined Bitwise 6.5 years ago, I was the CEO of ETF.com. So this is a space I know well. The most successful ETF launch prior to these was the Qs, the NASDAQ 100 Qs, which launched in the 1999 tech bubble, right? Perfect timing, and gathered $5 billion in assets. And the Bitcoin ETFs are up to 20. The year's not over. I think that number could go up significantly after we get past the election. So maybe we end at 25 plus billion dollars. So that's not just beating it, that's like shattering the record, right? It's not even close. Investors were very eager to gain exposure to this asset class. The ETFs came off with an incredible offering from a price perspective. And that's just a perfect combination. And to see 20, it's going to be 25. It could be more than that, $1 billion in their first year. Yeah, it's just a grand slam.
Yeah, it really seems that way. Some critics might look at the ETF flows and say, oh, it's just been a rotation of, I don't know, other funds that were held up in the grayscale, high fee ETFs that have just moved it to lower fee ETFs, or folks that have just been moving their Bitcoin that was on chain into somewhere that's more tax efficient. I'm curious, based on the data that you've seen it, we can focus on Bitwise or just the broad space. Who are the marginal buyers, and has it been different than what you thought it would be?
I think there are two groups of marginal buyers that we're seeing as very real adopters. One is retail investors. That one's a little bit surprising because it is so large in size. All right, something like 80% of those assets are coming from retail self-directed investors or smaller institutional investors, and that's probably exceeded my expectation. I don't think that's all rotation. The $20 billion is net of the money that's flowed out of GBTC. So that's net of that money. So that's net new investment. I think that's a lot of people with retirement accounts that couldn't access crypto, adding exposure in that space. And it's honestly just a lot of people for whom the ETF is the easy button. I know those of us in crypto thinks it's completely normal and easy to have a wallet or have a Coinbase account and buy Bitcoin. But for my father or my uncle or whatever, that's not what they do. They have a Schwab account and now they can access Bitcoin. So I think that's net new. The other place that's really taken off is independent financial advisors and family offices. So not broker dealers, not Morgan Stanley, not UBS, not Wells Fargo, but independent RIAs, registered investment advisors, as we call them. That's Bitwise's core bread and butter. We talk to them every day, and you've seen enormous growth there. Even if you just look at those flows, it's the most successful ETF launch of all time. So RIAs and retail have been the big buyers. Retail has been a little bit surprising in just how fast it's been, but I'm not surprised that both have succeeded. The ETFs are actually just a great product for buying Bitcoin.
Yeah, there's no doubt. I mean, again, like you just said, 20 billion or so in net inflows in Bitcoin has been fantastic. But then, I go and look at the ETH net ETF flows, and it's quite a different situation. I think the last time I checked, it was about negative $500 million in net flows there. Why is there such a dispersion between the two? What's going on? What's your perspective?
Yeah, I think there are two factors at work. So the first is I think there were a lot of non-long biased investors in ETH, the grayscale product, right? Because once the Bitcoin product converted, everyone knew we would eventually get an Ethereum ETF. Now we got it faster than we thought, but everyone knew that would happen. And so I think a lot of the assets that were in ETH at that point were people arbitraging the discount in that market. And those just rotated out when we switched over to an ETF. If you look at the individual ETFs, they're doing quite well, right? iShares is above $1 billion. At Bitwise, we're around $300 million. $300 million in 3 months in an ETF is like one of the 50 fastest growing ETFs of all time, right? So doing just fine from that perspective. But I think a lot of money rotated out of ETH and the arbitrage play. The other factor is that it was just too soon. I mean, I said this before the ETF launched. It would have been better to launch those products in January or February of 2025. People are still getting their hands around Bitcoin and their hands around crypto and accepting crypto as an asset class. Once you have to have a complicated conversation about how Bitcoin is different from Ethereum with a financial advisor, that's like a many month conversation. It would have been better to have more time for Bitcoin to season before we got ETH. But, look, I think we'll look back in a couple of years and there'll be $10-20 billion in Ethereum ETFs and everyone will be happy. It's just right now out of the gate, there have been net outflows.
Yeah, that's fair. Did it surprise you and your team or catch you off guard, the speed in which the ETH ETFs were approved? Because I know myself, there's a lot of time to prepare for the Bitcoin ETH the Bitcoin ETF, but the ETH one just sort of came out of nowhere, and we're just like, oh wait, wow, okay, this is happening.
Completely stunned.
Yeah.
Completely stunned. I mean, we prepare for everything at Bitwise, so this is not abnormal, but we were preparing both for a launch and for a not launch from a PR and messaging perspective, just because it was unclear what would happen. So I think it was shocking. I thought they would ask for more research or more time, but I think the SEC realized that they were painted into a corner. If you've approved the Bitcoin ETF, the same exact logic, the same exact statistical analysis can be applied to Ethereum. That's what we did in our application, which they referenced in their approval notice. And I don't think they wanted another grayscale type lawsuit, right? So why not just launch it, get rid of it? And again, from a short-term perspective, yeah, it probably dampened flows. But where we're going to be as an industry in 3 or 5 years, we're going to be happy we have those ETFs in the market.
Yeah, that's super valid. So, maybe what we could do here is just go through a little thought exercise to just think through the value proposition of Bitcoin and ETH and just really look at it from the institutional and allocator perspective that you have. Do you do you feel like there's also just it's a bit more difficult to sell in ETH? The narrative for Bitcoin is really obvious, digital gold. But if you ask 10 people what their value proposition is of Ethereum, you probably get 10 different answers. How do you pitch it when you're talking about Ethereum? And do you think there's just a lack of agreement on what really is Ethereum doing?
I think there's a lack of agreement. I think ETH is still sort of figuring it out. So I don't think it's that people haven't, sort of grokked what ETH is doing. I think ETH is still finding its exact place in the world. When we talk about Bitcoin, we talk about it as sort of filling the same role as gold, but in a digital format. And that's a beautiful, simple narrative. I think it's accurate. I think a lot of people are concerned about fiat debasement. I think a lot of people are concerned about hedging against inflation. I think a lot of people think monetary authorities are out of control. And so Bitcoin sells easily into that. Also has an easy valuation metric, right? You can look at the market for gold, you can look at the market for other stores of value, and you can arrive at a valuation target for Bitcoin. So that's easy. When we talk about Ethereum, what you're talking about is a public computer. We talk about it as a new platform on which you can build applications that can change the world, right? So just like iOS is a centralized platform on which applications like Uber are built, Ethereum is a decentralized platform on which applications are built. The beauty for institutional investors, if you look at the killer apps in crypto outside of money, they're all built on primarily Ethereum. Stablecoins are an absolute killer app that institutional investors can understand. The majority of stablecoins are issued on Ethereum. Tokenization is a killer app that institutional investors are more excited about than the reality in the market, but it's still a big idea. And all of that, or most of that, is being built on Ethereum. Even when you get to sort of individual applications, a lot of them resolve to Ethereum as well, right? Polymarket built on Polygon, but resolves ultimately into the Ethereum ecosystem. So when you talk about this new application, sort of new application layer on which killer apps are built, I think that appeals to institutional investors. But it's a more complex story, right? And it's a more complex valuation case, and it's newer. So I think it will inherently take more time.
Yeah. How do you think through the opportunity cost of either, Bitcoin's really easy to just sit there on the side and hold for decades in an ETF, but there's more utility baked into Ethereum. So, there's this opportunity cost dynamic of deciding, okay, I'm going to take my Ethereum off chain and actually put it into an ETF where I'm losing a lot of utility. Is that a concern for you? How do you think about that?
Yeah, look, most of the people we talk to who are deeply into crypto own it in two ways. They self-custody Bitcoin and then they hold a Bitcoin ETF because a Bitcoin ETF is easier and fits into many of their investing frameworks. I think the same thing is true in Ethereum. People use it for utility reasons and they use it for speculation and investment. For utility reason, like, I own some Ethereum in a wallet because you use it in the DeFi ecosystem. But most of the ETH that I own is in an investable format in funds. And I think that's the way that people think about it. So, what's another example? I carry around some cash in my wallet, but most of my fiat assets are invested in stocks in a brokerage account. It's the same exact idea. So I don't worry about that. It's just two different use cases, two different users.
Nice. I love that comparison. Okay, so the next big thing they're all waiting for is options on ETFs. So there's started to be a little bit of talk. I believe the only ETF that's actually been SEC approved is the BlackRock one. But want to hear from you. What's going on in the options world? Are they coming? Are you hoping they're coming? And what do you think is going to be the impact of actually getting options in the crypto space? Obviously, we have already had things like Deribit, but I do feel like it's quite significant to have it actually, in the more TradFi ETF space.
Yeah, absolutely. So first, just from a clarity perspective, the way options work is sort of like a nuclear launch thing where you need a key to turn from the SEC and from the CFTC. What we've had so far is from the SEC, and we're
Got it.
waiting for the CFTC. My ultimate expectation is that will happen, and it will happen for multiple ETFs, not just BlackRock. But I actually really like the framing that you offered when you talked about we already have Deribit. A good way to think about the impact of ETF options is to imagine the world if we didn't have Deribit and we didn't have perps. Like, what would the Bitcoin world look like if we didn't have any derivative activity on it? It would be a fraction of the size it is today. There would be a fraction of the number of applications, and maybe it would be a little bit less volatile, to be honest,
Yeah.
because people use that for speculative purposes. That's actually the right framing for what's happening in the traditional market, right? So now we have regulated futures on the CME and some regulated options activity, although it's relatively small. ETF options are traditionally very successful. Introducing options on ETFs into the ecosystem opens up this derivative space. What will it do? It will make the space more valuable. It will bring in more actors. It will further the financialization. And then at the extreme edges, like at the extreme edges of the volatility activity, our view at Bitwise is it can amplify volatility. In
Hmm.
the median case, I think it reduces volatility because it provides hedging instruments, but it
Yeah.
does create the possibility for these far out outcomes on extreme tail events where you can sort of play into yourself. But ultimately, it's a huge net good, right? If we want Bitcoin to be part of the normalized financial ecosystem and to be used as a macro asset by institutional investors, they need all the tools that they have for every other asset. A big tool is regulated options, and particularly on ETFs. That's what we're going to get. It's a positive signal, and I suspect we'll get it in the coming months.
You already hinted at there, but I would say that some critics would say, oh, it's not great to just start stacking on layers of derivatives, and that's just the long time criticism of all derivatives across all financial spaces. Oh, it's just Wall Street creating more speculation vehicles, but it sounds like you're more of the opinion that it can actually either dampen or lower volatility, or just be, yeah, again, like a more effective hedge vehicle in that.
Yeah, I try to keep it just really simple, which is Bitcoin is, I mean, particularly Bitcoin is ultimately a
Mhm.
financial asset.
Yeah.
And so if you want it to function as a financial asset, you need all the things that finance people do.
Mhm.
Another way to think of it is there's a group of investors who won't participate in this ecosystem without a robust regulated derivatives market, which right now we don't really have. And so you're bringing more people into the ecosystem. The sort of uh, you've seen it with gold for years. These people worried about paper gold and the financialization of gold, and you can sort of walk yourself into tortured philosophical argument why that's wrong. And I think that's sort of way too mid curve. I think the reality is just think of it as a financial instrument. You want finance people to have all the tools at their disposal. Right now, they don't have all of them. They have some of them. Maybe another way to frame this is these exact same arguments were made a year ago about the ETF. We don't need a button. We don't need the ETF, right? People can already access it. It's paper Bitcoin, etc. What's happened? It's dramatically broadened the group of investors who participate in the Bitcoin ecosystem, and the price is up substantially. I think the same thing is true here on derivatives. Just think of it as broadening the network of people that can participate in Bitcoin and making Bitcoin look like more of their assets so it can be used at the largest banks in the world in their
Mhm.
strategies. That's going to be the primary impact. There's probably some derivative overlay issue with paperized Bitcoin, but I think it's overwhelmed by this normalization factor.
Matt, what else are you excited about in the ETF landscape? Because we've got the Bitcoin one, we've got the ETH one, but now we're starting to see some filings for some more sophisticated types of ETFs. You've been a veteran of the ETF world for many years. I want to hear from you. What are you excited about? Is it ones where you're starting to see these index ETFs, where it's like a portion of Bitcoin, a portion of ETH, some more sophisticated, I don't know, rotational type of ETFs? What are you excited on? What's got you fired up?
Yeah, all of it. So let's start big picture. If you think about where we are today, I think people are somehow underestimating the amount of change that could take place in a year from a regulatory perspective. It's like we didn't learn the lesson of this year that you can go from not having an ETF and it being impossible to ETFs being one of the most important things in Bitcoin and one of the most important things in ETH, and something we talk about all the time. And they don't imagine that we could make that same leap again next year. But I actually think that's the case. I think next year we could be talking about a wide array of ETFs on a wide variety of assets and sort of a 10xing of the ETF ecosystem. So that's one thing that I think people are generally missing. In terms of specific strategies, there are a lot that I'm excited about. So I am really excited about index-based products. Bitwise runs the largest crypto index fund in the world. For most investors, I think an index-based product is probably their best choice. They just want exposure to crypto. If you look in the traditional ETF market, index products are overwhelmingly the way people gain exposure to the market. So I'm very excited about what index products could do in terms of bringing in a broad array of investors. I also think there are a lot of interesting things you can do from a strategy perspective, whether it's momentum strategies that sort of reduce risk for people or option overlay strategies that reduce risk for people. I think there are a lot of people on the sidelines of crypto because they're worried about the 70% drawdown. And there are various ways that you can mitigate that from a
Yeah,
strategy perspective,
like a covered call strategy and that sort of idea.
like a covered call strategy, or even a long flat strategy, or a strategy that's buffered. And you see that in the traditional ETF market with all of those options. And I think you'll see that in the crypto market. And again, the big thing that will do is move people from the sidelines into this market. That's ultimately what all of us are trying to do. What all the ETF issuers, I think, are trying to do is take people who aren't investing and help them invest, or take people who are investing a little and help them invest more. And you do that through education, but you also do it through product design by coming up with products that do that kind of risk mitigation in interesting ways. So I'm
Mhm.
really excited about that in the next year or two.
Yeah, totally. So, answer this only to the extent that you want to slash feel comfortable. But what does your team look at in terms of deciding on the process of what to file for next? Because there's a lot of speculation of, oh, okay, Solana is going to be the next big one, but then there's talk of, oh, we need to see like a futures ETF be filed first before we see the spot. So, yeah, like how do you guys think about that internally?
Yeah. So, I mean, you only want to file for products that you think you can launch, because there's significant legal costs involved in filing and significant headache costs. As an example, when we filed for our Bitcoin ETF, we ended up submitting 500 pages of academic research. That's a lot of work, right? So you don't want to do that unless you think there is an avenue to march forward. So one is, do you have an argument for why the SEC will approve it? And I actually think there are good arguments to be made for a number of the large cap assets today that I haven't seen articulated, and Bitwise plans to articulate many of them in the coming months. So I'm optimistic on that. And then the other thing that you really want to look for is an asset with staying power and a strong community behind it. People overlook sort of the importance of community in crypto. But if you look at something like Solana, yes, it's very exciting, all the applications and the technology, but it's also very exciting that it has this strong community around it. Other examples of assets that have strong communities, some assets people love. There are many new assets, whether it's Sui or Aptos or Monad, that people are very excited about. And then there's some legacy assets that, like XRP, that have very strong communities and are doing very interesting corporate development work. So you want to look for a thing you can launch and then something with strong community. And I think the combination of that is the right place to look for launch products.
What do you think is the biggest misconception people get around ETFs, ETF flows? Because if you go on Twitter on any given day, people will be digging deep into the daily flows data and try to extrapolate into price predictions. And oh, okay, it's the causal effect of today's price action. Oh no, it's the causal effect of tomorrow's price action. There's a lot of back and forth. So what's the biggest misconception that you've seen?
Yeah, I would say there are two. There are two different sides of the spectrum. One is the obsession with daily flows is completely wrong, because the way authorized participants work, the flows that you see reported in an ETF today may have come in yesterday, may have come in the day before, may be coming in 2 days from now. Right? There's not a one for one exact alignment of when an end investor wants exposure to X and when you see a flow posted on the board. And because people don't understand the plumbing of that, they overly focus on daily flows. My advice would be, look at weekly flows, look at monthly flows. Monthly flows really smooth that out, and you get a feel for where people are going. Daily flows, I don't know, we had $100 million in our ETF the other day, and then we had zero. It
Yeah.
wasn't that there was zero demand; it's that APs are averaging it out.
Mm.
So that's one mistake. The other, the biggest mistake, the most important people mistake, I think 90% of people in crypto are making, is that they don't realize that ETFs are multi-year stories. So
Hmm.
usually in an ETF, it really struggles to get any assets in its first 6 months or its first year or its first 2 years. And it hits its stride in years three, four, five, six, seven, and eight.
Mm.
If you look at the gold ETF when it launched,
Yeah.
everyone was excited, the best performing ETF of all time. Year one was the smallest year I think maybe it ever had until it had a negative year. It had 8 years of ascending flows. The reason I bring that up is I've high degree of confidence that flows in 2025 will be bigger than flows in 2024. And then I have a high degree of confidence that flows in 2026 will be bigger than 2025. The reason for that is it's still getting turned on at Morgan Stanley. It's still getting turned on at Wells Fargo. People are still studying it. It's moving into the mainstream. So the biggest mistake I think people make is like imagining that we're on this one-off rocket ship that then lands. It's actually no, this is a staircase, right? That's the way every ETF almost ever has worked. Maybe this time it's different. Who knows? But my bet is that we're on that staircase and we're going to look back in a few years at like, oh, wasn't 2024 cute?
Hmm.
We
Yeah.
did $20 billion. Like, great.
Yeah. Hey everyone, this episode is sponsored by Polkadot. Out of the 500 protocols, one of them is called Origin Trail, and they're building a verifiable internet for AI, ensuring the provenance and verifiability of data to tackle challenges like bias and misinformation in AI systems. Used by global leaders like the British Standards Institution and the Swiss Federal Railways, Origin Trail is vital in sectors like asset tokenization, healthcare, and the metaverse. Powered by Polkadot, Origin Trail enhances the discoverability of crucial knowledge and secures information in the AI era. Power the verifiable internet with Origin Trail at origintrail.io. This episode is sponsored by Mantra. The Mantra chain, built with the Cosmos SDK, is the blockchain of choice for regulated digital assets, offering compliance-ready modules and cross-chain interoperability. With partnerships like a $500 million tokenization project with the MAG Group, in collaboration with Zanbank in the United Arab Emirates, Mantra is at the forefront of the RWA revolution. Scalable with up to 10,000 transactions per second and secured by a sovereign proof-of-stake validator set, Mantra is designed for both permissionless and regulated applications, making it easier for institutions to enter Web3. Discover more about Mantra's capabilities and how you can participate at mantrachain.io. All right, back to the show. I love that the way that you piece that together. One thing I want to ask on that is what are they actually doing when they're going through that due diligence process? Is, in terms of like the actual companies and their compliance departments, like, are they just looking at, I don't know, correlations, flows, the value proposition? Those 500 pages of stuff that you said you filed and the like. What are they actually looking at, and what's that process? Because I always hear that, but I'm like, okay, what are they actually doing? It's been almost a year that we've had the ETFs.
Yeah. I think the first thing to remember is that they are dealing with hundreds of ETF launches every year,
Hmm.
and they're like 4 or 5 guys and
Yeah.
women that are running this, and they do quarterly meetings because they're at a bank. So they're probably looking at one thing for 3 months and then another thing for 3 months, and we're like, "What are you doing?" And they'll tell you, "We have 500 ETFs, and so you get 1/500th of our time," right? And so I think that's an important element. In terms of what they're looking at, they do really extensive due diligence on everything from custody to trading to the ETF issuer itself, to the liquidity of the asset, to how the AP structuring is worked out, to how the executions are taking place when they're getting orders for Bitcoin ETFs. You're talking about massive documents of due diligence, right? Tens and
Mhm.
tens and tens of pages from all the different ETF issuers, maybe not everyone, but all the large ETF issuers. And then they're weighing them and discussing them. There is a mismatch. It's sort of like a foundational fact about crypto, but there's a mismatch between how fast we work in crypto and the speed at which TradFi works. This is actually fast. Like Morgan Stanley approving an ETF in 6 months doesn't happen very often.
Mm.
This is actually fast. So that's what they're doing. But like on something like custody, they'll go pretty deep, right? They'll go deep into how is Coinbase actually custodying this? How does the insurance work? Like, how did they set it up? What are the procedures that and risks? How much can one individual control in terms of where this asset moves or not? right? So they are really digging deep and ticking the boxes. It's actually admirable work.
Okay, so earlier in the show, you mentioned how in a year's time, the world could look very different from a regulatory perspective. Obviously, that brings up the fact that we have an election in a month from now. I know you've been writing about some of the dynamics. Obviously, we all know the Trump side is pro crypto, but we've also seen some developments from the other side of the aisle in terms of Democrats. How are you thinking about the regulatory landscape as we go into the election, and then figuring out how to operate after it, basically?
Yeah, I think there are probably three worlds you can think about. So you can think about the Trump victory world, the split government world, however that works out, or a Democratic sweep of the House, Senate, and White House. I've written about this. I think the only negative outcome is a Democratic sweep of the Senate, the House, and the White House. The reason that's a negative outcome is not necessarily that we'll get the same sort of hostile attitude we've seen in the Biden administration, because I think that will pass, but rather because we won't know the direction of travel for maybe 6 months or a year, right? Like crypto won't be number one on the agenda. And so we'll exist in this world of regulatory unclarity, administrative unclarity, legislative unclarity. And the world hates a lack of clarity. Like we just hate it. And so that's a pretty negative outcome, because we'll be left in the same state we're in right now, where we don't know what's going on for another year, and that will drive us nuts. In the mixed government outcome, I think you can expect to see relatively positive developments for a few things. I think you can expect to see relatively positive developments for stablecoins. They have massive support on both sides of the aisle in Congress. There's a reason for the US government to support them. I expect we'll get a bill there. I think you'll see relatively positive outlooks for tokenization. And I think you'll see a relatively positive outlook for Bitcoin and Ethereum, because they're already through the regulatory hurdle, right? There's already relative clarity. I think what suffers in a mixed state is the altcoin market, because
Yeah.
there's more regulatory risk around those. And again, even if there's not hostile regulatory activity, there's this shroud of uncertainty. So if you're a large bank looking to do a tokenization project, are you going to be building it on a new blockchain if you don't have clarity on where it sits on a regulatory perspective? No,
Hmm.
right? You're going to build on Ethereum, which at least has some element of regulatory clarity. So I think that's that world. I think it's probably pretty good for
Hmm.
Bitcoin and ETH, but the altcoins may suffer.
Yeah.
And then, in a Trump world, I think the market immediately assumes that you make significant progress in opening up the market, and you'll probably see altcoins do quite well in that world. That's at least over the short term. In the long term, I think we end up in the same place. So in the long term, my view is that Washington has turned the page from its traditionally hostile view towards crypto to something that's at least neutral. I think you can see that in the bipartisan support for many pieces of legislation. I think you can see that in the SEC relaxing SAB 121 to let BNY Mellon custody Bitcoin. I think that shows us that we've moved from like -10 to -3. That's still pretty good progress. Like we can take -3. Um, and eventually, I think we'll get to a good place. It's just sort of the speed at which we get there will depend a lot on what happens in November.
Yeah. What do you think is the most important regulatory clarity to get? Is it around stablecoins, securities law in terms of altcoins? What's the most prescient that you think is needed?
Yeah, I think there are a few things. So I think it's just clarity on, particularly on altcoins, and how and where they'll be regulated, and whether they qualify as securities. It's a pretty existential threat, right? Like the core of securities law focuses on insiders disclosing information. If you assume crypto assets are securities, then there need to be insiders who have special information to disclose it, and a mechanism for disclose it. I don't know how a decentralized project achieves those goals in the
Yeah.
current format, right? So it's a relatively existential question. So providing some clarity and a sandbox will allow the industry to leap forward, and I think that will be really important. Outside of that, obviously, I'd like progress on what you can do in an ETF wrapper. I think that will help normalize the market. And then I think we're going to get stablecoin legislation. And it's just a question of how beholden that legislation is to the traditional banks or to more entrepreneurial aspects. But I think regardless of who's in charge, that's going to march forward. I think that's fait accompli.
Yeah. Do you think we need like a new version of the Howey test that's more aligned with, tokenized digital assets, or do you think that framework is still useful, 100 years later or so?
Yeah, I mean, my guess is we need a new thing. We need
Yeah.
a new thing for digital assets that have programmatic disclosure and clear standards. And look, I don't think the crypto industry has done itself any favors. I think there are like a lot of projects that have unfair token distributions and unfair lockups. There are a lot of projects that have unclear governance where it is the case that insiders are making decisions, right? I think that's just objectively true. But it's also true that until we can at least put some projects in the good bucket and some projects in the bad bucket, no one's going to build serious applications for US users in the good bucket. And so we just need to provide reasonable clarity and a way that a decentralized blockchain can meet the standards required of disclosures and these sort of items. And that's probably a new thing. Like, I don't
Mhm.
think, I don't know, the Howey test had a good run. When was the Howey law? Like, it's 100 years old.
1913 or yeah, yeah,
That's awesome. Like
yeah.
congratulations. That's amazing. Guess what? We have something new 100 years
Mhm.
later. Let's let's
Exactly.
let's let's accept that and put some standards around it that are fit for purpose.
Yeah, totally, totally. Okay, so we've talked about all the ETF innovation that's occurring, but one of the big questions we get on the show here, we have a pretty tradfi audience that is, I would say crypto curious, and the big question is, how do I bring, a Bitcoin allocation into my portfolio, and how do I size it? And actually, I was reading an interesting newsletter that you put out the other week, just comparing different, basically standard deviations, correlations, and how that affects Sharpe ratio. So I have this up here, and I would just love for you to walk through how you think about portfolio allocation in terms of just the traditional 60/40 and how Bitcoin can be incorporated into it, and how that actually affects both return and volatility.
Yeah, absolutely. I mean, the first thing to remind traditional investors is that like Bitcoin's not like a virus. If you add 1% Bitcoin to your portfolio, you can lose 1% of your money. It doesn't infect the other 99%. Nothing terrible happens. You buy it and you wake up the next morning and you're just the same as you always were. Um, we love this study. It's looking at what happens when you add 1, 2.5, 5% Bitcoin to a 60/40 stock and bond portfolio. And I think this really teaches you an important thing. So I would look at the 2.5% line. That's sort of the average Bitwise client allocation. And what you see here is that adding just 2.5% Bitcoin to a traditional portfolio significantly boosts your overall return, right? 50% over this time period. It boosts it multiple percents over a 1 year or 3 year period. And then the important thing is it does that without increasing the standard deviation, right? Your standard deviation goes from 10.25 to 10.58. And the reason for that is something that everyone knows, which is Bitcoin has low correlations to stocks and bonds. And when you put a low correlated asset and rebalance it in a portfolio, um, it leads to higher risk adjusted returns with no real impact on volatility. You can see here, yeah, the correlations we have from our quarterly report. The US equity correlation is below zero point 0.5, which means it's still low. That's actually elevated from where it usually is. It's usually below 0.25. But even at 0.49, it's still so much lower than the correlation between most assets. And it's simply additive to portfolios,
I
right?
feel like this is a huge misconception because you always see, people say, "Oh, Bitcoin is just levered Nasdaq," but when you actually quantify it, like a 0.49 correlation is not that high.
It's yeah, it's technically low. And when you get people to step away from it and think about why, I think it hits home. Like, what drives Bitcoin? It's education, it's the passage of time, it's regulation, it's fiat debasement. What drives stocks? It's economic growth, it's taxation, it's technology breakthroughs, right? These are just different things. And so different drivers lead to different results, lead to different correlations. And again, assets can be as volatile as you want. And Bitcoin is pretty volatile. It's as volatile as like the Mag 7. It's pretty volatile. But assets can be as volatile as you want. But if they're not correlated and you rebalance, you get this beneficial effect. Now, we do see, and we've done a study on this, that when you get above a 5% allocation to Bitcoin, it starts significantly impacting your maximum drawdown in your portfolio. It becomes the driver of that maximum drawdown. And so we think there's behavioral risk above 5%. But at 2.5%, it's like Cholula for your food. If you add a little bit, it makes it taste better.
Yeah.
And no one's just drinking a bottle of Cholula. That's
Exactly. I don't actually have the chart, but I believe you did the same study for gold, correct? And what was the implications there?
Yeah, the thing about gold does the mental model to compare Bitcoin and gold is that they're both portfolio diversifiers, but they have different effects. So Bitcoin increases your return historically without increasing your volatility. Gold lowers your volatility without lowering your return. So Bitcoin, more return, same volatility. Gold, same return, less volatility. It's actually a pretty different effect,
Totally.
right? I
Yeah.
think a lot of people lump them together, but it's a
Mhm.
pretty different effect. One is more aggressive and one is more defensive. The other difference, and this is a huge one, is you have to allocate so much to gold for it really to matter, right? You need like a 10 or 20% allocation. It just doesn't have the juice. It has very
Mhm.
small impacts. And I think that makes Bitcoin that much more valuable, right? You can keep 98% of your investments in traditional stocks and bonds, which are great long term investments, and just have a 2% allocation to Bitcoin. And you have a bigger impact than if you had 20% of your portfolio in gold. And then you're giving up all that upside in the stock market. So I think those are the two important things to think about: the directionality of the impact and then the scale of the impact. Bitcoin's just much more efficient.
Yeah, when you say that, it sounds super capital efficient. It kind of reminds me of almost like just buying some like leap calls or something and just adding on your portfolio. It's like, okay, if you just add 2% of leap calls, you get high upside, but your downside is capped at the price of the option.
That's exactly right. The other thing I say to people is, people think they're buying gold to hedge against inflation, and it's true historically that gold holds its value over long periods of time. But that means if you have a 10% allocation to gold, you've hedged 10% of your portfolio against inflation. Like,
Mhm.
great. You didn't have any impact on anything else, right? You
Yeah.
didn't actually achieve the end. And Bitcoin solves that problem, which makes it a
Yeah.
really
Yeah.
unique asset.
Yeah. It's like one's like a convex hedge and one's a bit more linear.
Yep,
I guess
exactly.
another way to think about it. Yeah.
Yep.
Cool. Okay. So you also wrote out your framework. Let's talk about what everybody wants to talk about, which is forecaster price and where the market is headed. You wrote an article where you had mentioned what are the steps and the conditions to get to $80,000 on Bitcoin. Do you want to hash out those steps and what you're looking at for that?
Yeah. First, I'll say that I love everyone throws out price predictions, but everyone just throws them out as if they're guaranteed to happen, which is just not true, right? Like they're all conditional. So at the start of this year, Bitcoin was trading a lot lower than it is today. We said it would hit $80,000 this year, and so I wanted to update. I think that's still true, but it's true only if a certain number of things happen. And I think the key things that have to happen is we have to see not a democratic sweep, right? We talked about this earlier. We can accept any other electoral outcome, but a democratic sweep would raise the level of uncertainty so much that I think there's no chance we would get to $80,000. So that's a big piece of the puzzle. We need to see continued economic stimulus and rate cutting. Like, I think the market expects two more rate cuts. I think it expects more stimulus from China. Maybe it's starting to expect Europe to try to do something to revive its economy. And it will be disappointed if we don't get that. And I think if it's disappointed, that lowers the probability of getting to new all time highs. And then the third thing is we need like no whammies. I feel
Yeah.
like we had a few whammies this summer. Like
It's been a
every
tough
time we
summer.
Oh man, every time we'd be going up, we'd be like, "Oh, the government's going to
Yeah.
sell its Bitcoin," or "Oh, now Mt. Gox is releasing its Bitcoin." Or so like, we need 3 months. Somebody else said on Twitter, "That's asking a lot in crypto." I agree with that.
Yeah.
It's asking a lot, but just no big whammies. But I think all those things will happen. Like I think we'll have no big whammies. I think we'll get a positive electoral outcome. I think we'll get continued easing and stimulus, and so I think we'll close the year at new all time highs. And then I think we'll run from there in 2025. So I wouldn't be surprised if my base cases were over $80,000. I wouldn't be surprised if we were significantly over $80,000 by the end of the year.
Look, Matt, that was a ton of fun. It's always great to get the insider perspective on what's going on in the issue world of these new ETFs that we all get to deal with. It was really great to hear what's going on and where you're excited about, where you're concerned about. If people want to find out more about Bitwise, yourself, your writings, where can they go?
Yeah, just go to bitwiseinvestments.com. I write a weekly memo. You can sign up for that called the CIO memo, or follow me on Twitter. It's Matt_Hougan. It's spelled funny, Hougan. I apologize for that, but it's been a struggle my whole life, you know.
It's spelled Canadian.
There you go. Exactly.
Yeah. All right. Awesome, Matt. Thanks for joining.
Thanks for having me.
There's over 500 protocols building on Polkadot, and one of them is called Polymech. Polymech is a decentralized, community-driven funding protocol on Polkadot, enabling regulatory compliant and transparent fundraising of Web3. Polymech ensures compliance with a novel KYC AML process, facilitating a trustless and automated funding process from fundraising to token distribution. By removing intermediaries, Polymech offers accessible, inclusive, and transparent funding opportunities for all participants. Powered by Polkadot, Polymech is redefining fundraising in the crypto space. Explore how to become a Polkadot VC at polymech.org.